Good afternoon, everyone, and welcome to today's Grain Market Update webinar. This is the fourth Outlook webinar that we are holding in place of last year's canceled Rural Economic Outlook Conference. Today, we will hear from Extension Grain Market Specialist, Dr. Kim Anderson. If you have any questions during the presentation, you may ask them in the chat window. Click on the chat button at the bottom of the screen to open the chat window. And for more information on grain marketing and other farm financial management topics, visit the eFarm Management website. I will share this link in the chat window. Dr. Anderson, I will turn it over to you now.
All right, thank you very much, Brent. Now, excuse me. Brent, you'll watch chat for me?
I sure will, yes.
Yeah, watch chat and then just interrupt me if there's a question.
I will do that.
Well, it seems everybody and their dog wanted a piece of time today. Been on a webinar listening, not participating, just listening. The WASI report came out at 11 o'clock. The planning intentions came out at 11. So if there's some errors in this presentation, it's from the rush of making sure this thing's up to date. I'd like to start out with a little farmer coffee shop talk. I saw this the other day. It says, push the button, brag about unpriced grain, or complain about unpriced fertilizer. And you can see that, of course, we know grain prices have been going up, and that's good, but fertilizer prices have also been going up. And you would expect that. With higher grain prices, you're going to have more fertilizer application to increase yields, because using fertilizer wisely will increase profit at current prices. I want to make a point that any number by itself is meaningless. Let's take the seedings report that just came out. Okay, we got the estimate for all winter wheat seedings. It was 31,991,000 acres. What does that mean? That number alone, with no other knowledge, doesn't mean anything. Hard red winter wheat acreage, 22,300,000. Now, if I told you that the trade estimate before the report for all winter wheat was 31,528,000, you can look at this and say, hey, they underestimated it. That should be positive for wheat prices. Our hard red winter wheat, it was at 22,140,000. It came in at 22.3. Or if I told you last year, all wheat acreage was 30.4 million acres. Hard red winter wheat was 21.4. Now the numbers start to mean something. And that's why in these presentations, we show you a lot of numbers, not just the current situation, because the current situation is what prices are based on. New information is what causes prices to change. And I'll talk about that in just a minute. Oklahoma came in at 4.3 million. It was 4.25 million last year. So about a 1% increase in Oklahoma wheat acres. If you look at forward contracts, this was this morning, in Medford, Oklahoma, you can forward contract wheat for about $6.14 a bushel. This time last year, it was $4.80. The basis is minus 15 versus a minus 30 last year. Forward contracting corn for next fall delivery was $4.25, 15-cent basis, versus last year at this time, $3.73. Sorghum was $4.85 versus $3.48 last year. Soybeans, $10.81 versus $8.75 last year. Canola, $7.65. I don't have last year's price. I'd suspect it was somewhere around $6, $6.25. And cotton, the futures price was 59 cents last year and 80 cents this year. Now, one other piece of information you might want to have is the current wheat price is $5.77 in Medford. Corn is $4.78. Milo is $6.45. Soybeans is $13.39. Canola, there's no price. And cotton, there's no price. So What was used to establish these prices? Think about it. Well, market information was used to establish the prices. The big analytical firms, the traders, got all the information they could get their hands on. They made supply and demand estimates, and they used those estimates to determine whether to buy or sell. If their buying price goes up, their selling price goes down. Well, what's going to cause these prices to be different tomorrow than they are today? New information. So I want to quickly point out you cannot predict prices because information is used to determine prices, and new information causes prices to change, and nobody knows what that information is. Now let's look at the market news, because that market news, that market information helps us establish the price. I read yesterday that China's hog production is back to normal, 700 million hogs per year. Now you can compare that to the United States, 120 million. And so logic would tell you when they're going from about 400 million hogs per year last year to 700 million this year, they're going to need more corn, they're going to need more soybeans, more soybean meal, they're going to buy more sorghum, and so prices are going to go up. It's going to support prices. Another piece of information is the dollar index is down 5%. Well, this means 40 cents more for wheat, a potential 40 cents, another 30 cents for corn, another 75 cents for soybeans. Because of a cheaper export price, farm prices could be expected to increase. Now, I read from some people that they're complaining about the dollar value going down, and for importers, it makes our imports more expensive. So it's a lower dollar. It also makes our imports cost more. Well, we can talk about all kinds of that. That's going to increase production in the United States. That's going to increase income or hourly wage in the United States. So there's positives and negatives from that index. President Putin in Russia's war on higher food prices. About 3 weeks ago, it was announced that they were going to increase their export tax by 25 euros. That's about $30 a ton, or about 82 cents a bushel for our corn. There's talk today and yesterday about them raising it to 50 euros. That's $1.65 increase in potential increase in our price. Now, we're going to have to take about 45 cents off of that for they have an advantage in export transportation, but that still gives us about $1.20 price increase potential because of Putin's war on higher prices. Now, one thing we could talk about there was what's that impact on Russian wheat prices? Well, to Putin's dismay, yes, he put that tax on that. That lowered exports coming out of Russia. That increased the world price of wheat, which increased the price of wheat in Russia. Now, did it increase it to full 82 cents? No, but wheat prices still went up with that export tax. There's news on U.S. wheat, corn, soybean ending stocks. They're all going down, and that's good. The Black Sea exporters dominate wheat prices. They've been doing that for the last 5 or 6 years. That's why we concentrate on news from out of that area. Brazil, Argentina, and Ukraine now dominate corn prices. We'll look at these in a little more detail in just a minute. And China, Brazil dominate soybean prices. Okay, we just got the WASDE out. World wheat production was estimated at 28.4 billion bushels. What does that mean? Well, it was 28.5 billion bushels last month. In 19, it was 28.1 billion. The 5-year average is 27.6. We've got an adequate amount of wheat. World wheat ending stocks are projected to be 11.5 billion bushels. It was 11.8 billion last month in the December report. That should be positive for our prices. Last year it was 11.6, and the 5-year average is 10.1. World hard wheat production, 8.7 billion bushels. That's about the same as it was last month. It just went up slightly. In 19, it was 8 billion. 5-year average is 8.4. Higher production in the hard wheat production countries. Black sea wheat was 4.5 billion. It's 4.2 last year. The average is 4.3. But what has Putin done? He's altered this. Yeah, we got 4.5 billion bushels, but he's not going to let as much go out for exports. 12.5% protein premium is 45 cents. That's almost exactly the same as it was last year. I left this up here. This is old news throughout the US and Russia. You got to be careful. For the last 3 or 4 months, the Weather Service has been predicted higher than average temperatures and lower than average precipitation. Our temperatures have been about average in the state and precipitation just barely above average. Lower in some areas. It varies across the state. The world's stocks to use ratio was 43% in today's report, is 41 last year, 38% on the average. If you look at hard wheat ending stocks, that's what we produce, 1.6 billion bushel, a 10-year average 1.7. So yes, there's a lot of wheat around the world, but hard wheat, bread flour wheat's relatively tight. The stocks to use ratio is 18%, 20% last year, 20 to 22% on the 5-year averages. Your hard wheat US stocks to use is 43%. That's down from last year. But the Black Sea stocks are 11%. This what concerns Putin, is that he does not have adequate supplies if they lose a crop. Now, I show this because it's changed. Well, no, it hadn't changed, but it made me wrong this year. I've been saying for the last couple of years, and you can look at the averages here, you need to sell your wheat in June, July, and August. These are the averages. This is the Oklahoma monthly average price. Starting July 1, I put 5 cents per month carry in it. Well, so I'm saying that based on this information, you need to sell your wheat in June, July, or August. And this year, if you had, well, it just improved throughout the marketing year. 508 in December, you've got that price up 575, 580 in January. It still pay you to hold that wheat, cover storage and carry. However, if you look at the averages across here, you would have given up much more in previous years than you would have this year. It's still June, July, and August compared to later out in the year.
Dr.
Will
Anderson?
this trend change? It's possible. Yeah, Brent.
Are you trying to share your slides because they're not on the screen right now?
Oh, thanks.
You're welcome.
There they are. Ha.
I don't still see them yet.
Okay.
There it is.
Oh, thanks. Let me just for grins. I'm not going to go over these. Here's what you're supposed to see.
Perfect.
This is probably the best part of my presentation here. To show you the pictures.
Awesome.
So on these, one point I should make, if you're determining what you're going to do with your land this year, use these prices here to determine the potential deals. Also on this slide, I neglected to say, I can find it laying here. Trent Malachek sent asking for cost of production estimates. Corn for wheat, he had $227 an acre. That includes, all of these include a $40 cash rent. Soybeans, $255 an acre, and corn, $285 an acre. So if you want to use these prices and your potential yields and your potential cost. That can calculate out your potential income. Went through that. I just wanted to point out that this is why we use numbers. This is why we look at the market news. So you've been seeing me the whole time.
We have.
That's too bad. Okay, here you go. We got to be careful to make sure our market hasn't changed here, but it still pays to sell in June, July, and August. Now, I've got questions about, Kim, what about forward contracting? And I don't have forward contract prices. So I just use the cash prices on these months, no carry or anything. And if you look at the monthly average prices across these years, you'll see that January, and I was surprised, normally it's out here in April. January is your highest price month compared, but it's almost exactly the same as June. So this tells me that, I probably don't want a forward contract or price before harvest. May is normally higher than at harvest. I'd ignore that, but that's just me. But I just did it. That's just a quick and dirty thing to look at. It warrants some additional research. Okay, any questions on wheat? Okay, corn news. Just read Mexican officials to decide if GMO corn ban will apply to feed. Now, they're our number one importer of corn. The story, as you read this, that was a headline, was that right now Mexico allows production of GMO, but it can only go into the feed markets. Are they going to implement this? That's anybody. If they do, we're in trouble. Because I think 91% of our corn production is GMO. World corn production came out at 44.6 billion bushels. That's down from 45.1 billion last month, 43.9 last year, and 43 average. So it's still above average. World corn ending stocks, 11.2. That's down from 11.5 last month. 11.9 last year and 12.8 average. So corn ending stocks well below average. World stocks to use ratio at 24.9%. It's 24.9 last month. It's down to 24.6. It's 26.8 last year. The average is 30.1. That means stocks to use ratios is down. That's positive corn prices. U.S. corn production projection went from 4.5, or last year's crop from 14.5 down to 14.2, 13.6 last year, and 14.3 average. Corn ending stocks, 1.55 billion bushels, down from 1.7 last month, 2.0 last year, and 2.1 average. And the corn stocks to use ratio, 10.6% compared to 11.4% last month, 14.4 and 14.5. So all these numbers support higher corn prices. Now on the news, back there on the news, remember I said that Argentina, Brazil, and Ukraine control or dominate the corn price. And if you look at the Argentine production, this year, 1.9 billion bushels. They're exporting 1.34 billion of it, or 70% of their production goes to export. Brazil, 4.3 billion, 36% exported at 1.54. Now, one thing I thought about here, you get Daryl Pill to talk about it sometimes. This tells me that Brazil has a livestock production in domestic use, more so than Argentina. But that's just kind of a wild guess type thought to throw out there. Ukraine exports 81% of their production for a total of 52% of the world's production are exports. The United States, 14.2 billion, 18% of our corn is exported, or 36% of the world's exports. Oh, and cotton prices have risen to their highest level in nearly 2 years, thanks to, and this, I just read into this today. I had some other stuff for cotton. Dry weather has shrunk the crop. You can look at the cotton. Yeah, those numbers are coming up. We can look at the lower production. And this is an interesting statement here. Demand is shifting from China over concerns of forced labor that have made a big chunk of the nation's fiber output. And there's a lot of thought can go into that statement. Okay, yeah, okay, the world's more concerned about the forced labor, about the way China treats certain ethnic groups, et cetera, et cetera. So we shift purchasing our textiles from China, from importing from China to other countries. All that's going to do is shift where our cotton is sold. The amount should remain about the same. And the big question is on cotton textiles, how is that going to, the demand for cotton textiles going to compare to your man-made textiles? And where's the demand going to be? So there's a lot going into that thought there. Also, so is your market flow, and is your market going to change in cotton? Right now, cotton prices are really looking good. If you look at the numbers that came out, 114 million bales in the world, 124 in 17, 113 average. World cotton ending stocks projected to be 97.5, 107 down from 107 in 14, 86.2 average. So world stocks to use ratio, 84% versus 76%. And so you look at this and you say, why are cotton prices going up compared to last year? It's lower production. You're building your stocks from last year, but it's still well below the 14 levels. U.S. 16 million bales versus 17.9 average. Ending stocks 5.7 versus 4.6 average, and stocks to use ratio 32.6 versus 27. So again, you've got increased stocks and higher prices. And you've got to ask why. And I do. And it's because the world demand situation has changed. I think it's changed for all the commodities, especially the grains and crops. Throw this cotton contract in here. You know, you go back to July of 18, prices down into January, February, April of 20, and then we're starting back up now. And this is, I think, you got COVID and other things going on in the market, and it may have changed the market philosophy on how much stocks is adequate. And I think it's increased demand around the world. I want to throw in the 90-day temperature and precip forecast. If I'm looking at this and I'm a wheat farmer and I say we're going to have above average temperatures for the next 3 months, now we'll have a new one of these coming out next week, well around the 15th or 16th, 17th of January. It'll be interesting to see how they change this. But if this is right and we have an above average temperature winter, it's possible for a wheat to come out of dormancy early, and it, in my opinion, would increase the odds of a late freeze. You know, just something to think about that. If you look at precipitation, it says below average precipitation. We've had average, slightly above average when they've been predicting this. Plus next week, they're talking about more moisture. It's either next week or the week after, more moisture coming in. So I think it's important to know what they're predicting, but it's also important to look at potential changes in production as we're making our top dress and as we're making our graze out decisions. I saw this the other, this is Tuesday. It's either yesterday or last Friday. 41% of all US dollars ever printed were printed in the last 12 months. And you look at printings from 2009. To me, as an economist, right here is something to ponder on. Now, the next question is the stage set for higher prices? And if it is, what's the foundation for the higher prices? And I think the stage is set for higher prices. One reason it's set, one is lower corn production. Two is increased wheat demand. And so lower stocks in wheat, lower stocks in corn, lower stocks in soybeans, lower stocks in grain sorghum. So the stocks are lower, and I think the demand has increased. Now, is the fear of inflation impacting our prices? In other words, is it impacting our demand? During inflationary times, does the market move to owning commodities? I don't have a definitive answer on that. My observation is that it does. If you'll watch countries like Argentina, where they are countries that's had runaway inflation, hyperinflation, you want to call that, the farmers and people will own grains, they'll own commodities and sell them on the market when they need the cash, or store them over the long haul to maintain their value and their wealth. Conversely, what can cause prices to decline? COVID getting taken care of, changes in your demand and stocks philosophy, plus higher production. That's about what I got for you today. Any questions?
I have now, people can unmute themselves to ask questions directly, and then people can also ask questions through the chat box. Currently, I do not see any questions in the chat box. So this is the time for questions. And as always, we also have a survey that we would like everyone to fill out. And so I will share that link in the chat box and keep monitoring it for questions. We do have our first question, Dr. Anderson, from Shannon Mallory. He said, I bought beans yesterday. What type of new truck should I buy?
Yeah, I haven't looked at that.
That's a joke. I've already lost the money.
You've already lost it. Yeah, that's what I was going to say. Let me make one last point, Brent. I think there's a lot of things to think about of what's going on in the market now. Two, relative to participating in the markets as a speculator or whatever, or as an investor, in turbulent times or times of volatility or with a large degree of uncertainty, it's been my philosophy just to stay out of the market. You lose gain opportunity, but you also lose the opportunity to lose. And the last thing is, I think one of the most important slides on this presentation is the forward contract prices, because you need to put a hard pencil to how you're going to use your land, labor, capital, and management this year. And those forward contracts, I believe, are the best estimates of what prices are going to be on down the road. The one thing we know for certainty is that they're wrong, but they're the best estimate there is on the available right now, in my opinion. And with that, I thank you for giving me the opportunity to visit with you. If you have any questions, comments, need any information, kim.anderson@okstate.edu or 405-744-9817. That's straight in my office. I don't want anybody to bother my secretary. She's the only one that's productive around here, and I'll make time. Thank you very much. Brent?
Thank
Sure.
you, Dr. Anderson. Still don't see any questions. I did share your email in the chat box as well, if everyone wants to write it down. I also like to let everyone know that our next webinar will be February 16th at noon. And in that webinar, Extension economist Dr. Courtney Burr will provide an update on the ongoing economic impact of the COVID-19 pandemic. So if there are no other questions, which I don't see any right now, I will thank everyone for joining us, and we will see you on the 16th of February.